Good afternoon, everyone. This is T3 Live Editor-in-Chief John Darsie here to bring you the daily recap. So today the market was actually a little bit stronger early than some might have expected, given the anxiety that's built up about the Russia-Ukraine situation. You had the Estonian government officials come out and say that it looks like Russia is preparing to invade. You have the Crimean vote that is a mere formality. They call it a vote, but when people are holding machine guns up to you when you're casting your vote, it's hard to really give it much legitimacy, but it's pretty apparent that Russia is going to at least annex Crimea and eastern Ukraine, and the real question is whether or not bloodshed is involved and whether a war breaks out, or there's some sort of invasion or anything like that. So that'll be what everybody will be watching for over the weekend. I'm not a political analyst. I don't know what's going to happen, but I think what a lot of people were doing today is just reducing some risk ahead of that weekend. I think both early on in this session, maybe you had some people covering some shorts, people that didn't want to be caught short if we didn't get an escalation of the conflict and we didn't get an invasion or something like that. And then in the afternoon, we saw weaknesses. I think anybody who was long or who had trading positions during the day or this week were looking to unload those trading long positions into the weekend. They didn't want to be caught long if we do get an escalation, we do get some bloodshed, we do get the beginning of what would definitely be a larger scale war than we've seen in that region in quite some time. So definitely a lot of headlines and headwinds today, and it was definitely the type of environment that was conducive to less active trading. And you saw a lot of traders sat this one out. I think it was very prudent to sit on your hands. That's not the sexy thing to talk about when you talk about game planning for trading. You always want to be looking to make money and identifying good setups, but sometimes the best trades are the ones that you don't make, and sometimes sitting on your hands is the best thing you can do. And I think today, as has been the case on a lot of Fridays this year so far, sitting on your hands was probably the best thing you could have done today. And that's what Scott, Mark, and a lot of other people chose to do. Anyways, I'll go through some of the action just to see where the weakness was today, which could forecast if we do get an escalation, we do open lower on Monday, what the sectors that could get hit the hardest are. I think the financials definitely are near the top of that list. They did have a resurgence recently, but overall they were still showing relative weakness for most of the beginning of this year and even towards the end of last year. Took a look at the XLF. Actually, first I didn't even give you a look at the spiders, but here's a look at the spiders. As I said, we rallied in the morning, went back above the 21-day briefly, but nobody really had strong hands on those longs today, and people unloaded them into the close. We didn't really accelerate lower into the close, and actually in the last 10 minutes or so, we bounced a little bit to finish slightly off of lows. That's being a little bit generous, but we didn't get any acceleration of the downside, so it doesn't seem like fear is completely out of control right now, but there definitely does seem to be some anxiety. But looking at the XLF, like I was doing, weakness today was strong in the morning, looked very similar to the SPY chart, but closed below its 21-day. But individual names are showing some more weakness there, ones that have more exposure to Europe. You take a look at one. Deutsche Bank today was actually a little bit stronger after opening down. If you look at something like Credit Suisse extremely weak. Yesterday it accelerated below its 8 and 21-day. Big gap and go to the downside today to get down near its 200-day, so a lot of weakness there. And then Citigroup, one that definitely looks very unhealthy to me. A bear flag type pattern after it broke down, wasn't able to really bounce much, got rejected basically by its 200-day moving average, and now continues lower. I talked about that one this morning. And then Bank of America, that's the strongest one, but it also showed weakness. Bank of America had been holding up sort of in a descending bull flag type pattern after igniting back here on March the 4th, but broke down hard today, closed below its 21-day, so maybe none of the banks are going to be spared in this action, but definitely something to keep an eye on. The most likely scenario, I think, this weekend is that you do get Russia basically annexing Crimea and parts of eastern Ukraine, and what that will lead to is sanctions from the European Union, from the United States, maybe some asset freezes of Russian assets, and so that would definitely cause some problems for the financial industry and the banks. So that's why I think why you saw some weakness there today, and in select names that have the most exposure to Europe, and maybe you're holding more Russian assets than others. But tech was also weak today. We're seeing some tech leaders break down, and that's one of the signals that we talked about this week in the morning call on Wednesday when I sat with Scott. One of the signals that tells us that things could be shifting a little bit right now. And I'll just run through those symbols pretty quickly. Take a look at Apple. Apple looked like it wanted to trade inverse to the market a little bit, but the last 2 days, a big engulfing bar yesterday, continued to the downside today. Amazon was looking better yesterday, and this one actually is holding up reasonably well, finished positive today, whereas most stocks finished negative. So this is actually one that's looking a little bit better, and one that if you are looking long, if the market does hold up next week and we don't get an escalation of these issues, and I think Amazon could be one to turn to, even though it is a lower level pattern. Google breaking down a little bit. It's accelerating below its 8 and 21 day. Doesn't look like it's going to reclaim it the same way it did the previous time that it broke. I mean, it was a big acceleration down through it back here in late January, but was very quick to snap back. This seems like a little bit more of a calculated sell-off that maybe isn't going to get that snapback, isn't going to reach those extreme oversold levels that leads to a snapback. Closed on its lows today, definitely not looking as healthy as it has for a long time. Netflix, another one that has been extremely strong but has a little bit of a rounding top type pattern forming. You see the fact that it broke below its 8 and 21 day moving averages, and that both of those moving averages are now curling down. And if you see the 8-day cross with the 21 day, that'll be another bearish signal. You talk about moving average setups as it broke yesterday's low and looks like it could continue to round lower. Tesla, another one. That ruling in New Jersey is getting a lot of attention, but I think overall Tesla just had a huge run, squeezed shorts, and now needs to work off a little bit of that overboughtness. And it's breaking back into this gap here, so something to keep an eye on there. It's still below its 21 day moving average, so overall that's healthy, but just another one that needs a rest, and I could definitely see it filling this gap here around 220. And then social media was weak today. Facebook, the leader in social media, somewhat similar to Netflix, a little bit of a rounding top type forming. Not as rounding as Netflix, but it did close below its 21 day. But I still think it's one that if the market holds up, turns higher, I think Facebook would be one of the ones that shows leadership still. But Twitter is quite the contrary. Twitter breaking down. Some people are looking for maybe an igniting move out of this lower level pattern, but below all of its moving averages, weak today, just traded down pretty much the whole day. This area will obviously be very big there, around $50. So if it breaks below that, it would be lookout below for Twitter. Until then, just showing some weakness. GLD was actually, looks like people took some profits on this morning's gap up. Some fear, about the whole Russia-Ukraine thing. But it's had a big run, so maybe people's taking some profits and hedging themselves a little bit into this weekend where it's unknown whether or not you're going to get some military action. TLT opened higher again, but again, some profit taking after a really strong multi-day move there, back into its 200-day moving average. JJC, which is copper. Copper's been a leading indicator for some of the weakness that we've seen in the market, and perhaps in response to some of the weakness that we've seen out of economic data in China. It's accelerated lower. On a monthly chart is the real pattern, sort of breaking below a head and shoulders pattern. Go back to the daily chart yesterday it continued lower. Today it opened higher, but then showed no commitment to the upside. So this definitely looks extremely unhealthy. Just XLU to do a little sector analysis. The sectors that are actually seeing money rotate in and hold up a little bit better, it's a flight to safety. The higher risk assets like tech stocks, like bank stocks in this era are getting a little bit of weakness, where you're seeing something like utilities, which is sort of like a surrogate for bonds. You're seeing utilities act well. 3 really strong up days, extreme relative strength today. Even look like they might break out. So impressive action there from the Utes. The XLU, if it can break above there, you got these 52-week highs here from around April, May 2013. So something to keep an eye on there as we see a flight to safety. A few stocks that caught my eye as potential shorts. I discussed a few of them this morning. But if you are looking to be short some, German assets, Germany has closer proximity and economic ties to Russia than a lot of countries. Some people looking at something like an SAP to potentially short. If I can type it in right. SAP got a little bit of a bounce today, so if you're looking to short a bounce on something like this, today was a potential opportunity. Same thing with Siemens, even a bigger bounce, big gap up and continue to the upside, but see if it gets rejected here by what I think is the 100-day moving average. But if you're looking to short a bounce, this was a big bounce to short, erased a lot of yesterday's losses, so something to keep an eye on there. Deutsche Bank, I mentioned, whatever. In GE is one that you might not think about, the fact that it has a lot of exposure to Europe, but I think 25% or so of its revenues are tied to Europe, and you can see big down move here, kind of a bear flag pattern, ascending channel, and today started to break below it. So you could draw this line here. Definitely not looking very healthy, and if it breaks this 200-day moving average, you could see a little composure shift there in GE. And some biotech names, mostly biotech. I'll show the IBB. The sector held up relatively well, no major losses there, but you're seeing sort of some rolling corrections in various biotech names based on news and things like that. Celgene, really extreme selling today, been one of the strong ones. Came back into its 200-day moving average. That's definitely a day to take notice there. And then Gilead. Gilead, we listed on off the charts last night as a short. It did gap below our entry price, but you did get a chance to enter for some downside during the session today, and definitely in a little bit of no man's land now. Broke this pivot here. Next support isn't down until you get into $72 and change area, so definitely some weakness there to keep an eye on. And then just the saga of the fuel cell stocks continues. A lot of short-term traders focusing on these. Plug, seems like every day it either gains or loses double-digit percentage. Today it was down about 15%. So I think you got to give these, if you're going to trade them, give them time. Let the volatility flatten out a little bit, and then potentially look to get involved in short-term type setups. But overall, these things definitely got a little bit overcooked. Anyways, that was the daily recap. Things pretty straightforward in terms of people taking risk off into the weekend because of the headline risk and things like that on both sides of the equation. That's why I think you didn't get extreme selling. I think most people are fearful of a gap down, but there's also the potential, like we've seen several times over the course of the last couple of years, where you get a geopolitical headline, everyone's scared about it, you get some weakness, and then when that geopolitical headline sort of fizzles out, you get big gap ups. So I think people are wary of that trend over the last couple of years. So that's why you didn't see people really running for the exits today. You saw more of an orderly walking to the exits type situation. But anyways, this weekend should be very interesting. Hopefully, obviously, you don't want any bloodshed, and the market doesn't want that either. So this has been John Darsie here for your daily recap. We'll see you back here on Monday.